Hey guys, Adam Carroll, Palma Capital Investments. Today we're going to be talking about one of the most important things that you need to look at when determining what market to invest in, and that is affordability, price to rent ratio, and rent to income ratio. You ideally want to invest in a market where people are spending less than 30% of their gross income on rent. You want to invest in a market that people consider affordable. If you're investing in a market where people are already spending more than 30% of their gross income on rent, you should not expect to see a significant market rent growth in the near future. You also want to understand the price to rent ratio. If the price to rent ratio is 15 or lower, then buying a home is relatively cheap compared to renting. If the price to rent ratio is 20 or greater, then buying a home is very expensive compared to renting. Let's look at an example. You have a $300,000 home that generates $30,000 a year in annual rent. How do you find the price to rent ratio? Well, you take the $300,000 and you divide it by the $30,000, and that equals 10. The price to rent ratio is 10. That home is very affordable when you look at purchasing it instead of renting it. This information will also help you determine if the market they are looking at is a high cash flowing market or a higher property appreciation market. If the price to rent ratio is 15 or lower, then the market has pretty high cash flow. If the price to rent ratio is above 20, then the market has a lower cash flow, but it has a higher property appreciation rate. Thank you guys so much for taking the time to watch this video. I hope you learned a lot.